Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times bestselling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby. Well, as you're listening to this, I'm excited to announce that The Soul of Wealth was just released 2 days ago. I hope many of you have already picked up your copies. If you have and you're enjoying it, please leave that 5-star review on Amazon or on Goodreads. It really helps other people discover it, and it helps me so much, so thank you very much. You know, initially I planned to only share 4 chapters of the book, but I'm actually going to share a secret chapter, a hidden chapter, if you will, today. One that was in the galley copy, but did not make the final cut of the book. I remember being a kid and having to fast forward to track 99 or something to hear the hidden track on a CD. So that's what you're getting today. A chapter that was in an early edition of the book, but did not make the final cut. And the name of this chapter is Emotion, Why You Should Beat It and Join It. Financial history books are full of examples of how periods of elevated emotion lead to some shady deal-making by unscrupulous opportunists, along with shaky financial decision-making among regular investors. Let's review some striking instances of how emotions drove wild animal spirits. We can go back in time to the tulip mania of 1637. During this common case study in speculative bubbles, people in the Netherlands were caught up in a meteoric rise in the price of tulip bulbs. At the peak, a single bulb sold for as much as the priciest mansions in the country. The fervor reached a more fevered pitch, but then the bubble burst, leading to major financial losses for those left holding a bag of bulbs. Jump ahead in time and skip across the pond to the roaring 20s, in which the U.S. stock market soared. Economic prosperity and broad optimism, built partly on the electrification revolution, lasted until October of 1929, with investor speculation running rampant during the latter years of the rally. Buying on margin became a popular strategy, leading to additional legs higher in the bull run. History rhymed, and the market crash of 1929 wiped out enormous sums as the Great Depression ensued. Emotion was similarly at the heart of the 1990s dot-com bubble. Allures of what the internet could do to business productivity and how culture writ large would change drove people to buy up stocks, just as we had seen in the 1920s. This time, though, you could do it with the click of a mouse. Euphoria also gripped startups and investment banks. The domestic IPO market was red hot, with new ventures seemingly going public each trading day. It was common to see IPO tech stocks soar hundreds of % on their first day of trading. Eventually, markets peaked and investors who were late to the party, perhaps feeling what we now know as the fear of missing out or FOMO, saw their online brokerage balances bludgeoned from March 2000 through late 2002. On the Mount Rushmore of emotionally driven bubbles is undoubtedly the real estate bubble in Japan during the 1980s. Seen by some as the new economic engine of the world, money poured into Japanese assets. Property was among the major beneficiaries. At the climax of the bubble, conditions got so irrationally exuberant that Tokyo's Imperial Palace was valued more richly than the entire state of California. What causes people, including you, remember you're not special and neither am I, to act so wildly? Well, it's all about emotion. Emotion colors the lens through which we see the world. It's a tendency psychologists refer to as the affect heuristic. Individuals in a euphoric emotional state commonly overlook risks and overpay. On the flip side, those in despair tend to see risk around every corner and can be paralyzed by inaction. A study conducted by social psychologist Jennifer Lerner and her colleagues quantified how emotion impacts our flawed evaluation of risk and our willingness to pay for a highlighter pen. The researchers broke out the participants into two groups labeled sadness and no emotion. The sadness group watched a clip from the movie The Champ, which depicted the death of a boy's mentor. They were then instructed to write a few sentences expressing how a similar real-life loss would affect them emotionally. The no emotion group, on the other hand, watched a brief video about fish, then were told to write about their daily activities. After watching these clips and drafting their short pieces of writing, all participants were told they were now participating in a second and unrelated study. Here, some were asked to set a selling price for a highlighter pen, while others were instructed to suggest a price at which they would purchase the same pen. The results were striking. Emotion had a massive impact on bids and offers in the experiment. Buyers in the sadness cohort were willing to pay 30% more for the highlighter versus those in the no emotion condition. Think of it like the retail therapy so many of us are prone to when we're feeling blue. And when selling, sellers in the sadness group accepted a price 33% lower than their no emotion peers. While a pen is just a pen, if we extrapolate these conditions to how we manage our money, the effects can be dramatic. I refer you to the financial market manias listed earlier. Excitement routinely causes sometimes rational people to overpay, be it for tulips, shares of a stock, or real estate. Then, despondency results when selling prices hit depressed levels, which is why bear markets exist. With all of this in mind, and realizing what a bunch of emotionally driven screw-ups humans are, it seems the optimal solution is to make decisions without emotion. The only problem is that emotion is everywhere all the time. According to neuroscientist and psychologist Antonio Damasio's somatic marker hypothesis, emotions play a crucial role in how psychological systems function. These somatic markers are responsible for helping us decide how to think and act. They can be thought of as our gut feelings. The hypothesis asserts that somatic markers serve as a kind of mental shortcut, enabling us to make efficient selections. Individuals with damaged markers were found by Damasio to have a difficult time making even the simplest day-to-day choices, like what to eat or what to wear. The crux of it is that we cannot oust emotion from every decision we make, particularly those with financial matters. So emotions can harm our financial decision-making, but they are also inevitable? What are we supposed to do? Well, as the old saying goes, if you can't beat them, join them. Martial arts demonstrates this well through what are known as circular techniques, whereby its practitioners, rather than trying to block a fierce attack head-on, are taught to roll with resistance, using the attacker's exertion against them. This strategy emphasizes adaptability, flow, and second-order thinking. Thus, we are better off minding our mental cues and emotions rather than dismissing them altogether. Salespeople are known to play on people's emotional biases to land a sale, but we can all use that logic to our benefit. The first step is being aware of our emotional tendencies and understanding how they influence our behavior. From there, we can make more thoughtful and deliberate financial decisions. It's no coincidence that the most effective behavioral nudge of all time might be the Save More Tomorrow campaign. This three-pronged policy plays on how we are all status quo prone, but in a positive and even lucrative way. Developed by behavioral economists Richard Thaler and Shlomo Bernartzi, the goal was to get Americans to set aside more money in their employer-sponsored retirement accounts by first asking participants to commit to saving more in the future. Second, higher contribution rates in later years are linked to future salary increases. And third, once an employee is enrolled, they remain in the program unless they opt out. By taking our mental foibles into account, avoiding present bias, reducing the impact of loss aversion, and making beneficial use of our inclination for inertia and the status quo, it is estimated that an additional 15.5 million Americans are saving and investing for retirement. Your 401k or 403b plan probably incorporates some of the facets pioneered by Thaler and Bernardsey, and see, you didn't probably even realize it. But perhaps all you want to do is save a bit more each month. One helpful trick you can play on your emotions to boost your savings rate is to use visual reminders to reframe priorities in your mind. Researchers Dilip Soman and Amar Chima carried out a study on how to get low-income consumers to save more. The most effective technique didn't involve computer algorithms or a crack staff of policymakers. Instead, all it took was a Polaroid. Pictures of someone's children or beloved family members helped low-income savers put away twice as much versus a control group. So if you want to see your savings swell, maybe stick a picture of your kids next to your computer monitor or go old school and pin a family photo to your bulletin board. In another instance of reorienting our emotions for the good, Pennsylvania-based financial services company SEI championed the bucket strategy in retirement saving during the Great Financial Crisis. They helped clients roll with the emotional punches by organizing investor funds into distinct buckets aligned with individuals' goals. SEI discovered that people who held goals-based accounts were dramatically less likely to sell out of the market at the lows in late 2008 and early 2009. Goals-based investing is now common and helps create strong emotional connections to your money, giving each portfolio a sense of purpose. On a personal note, I took the words of a former boss to heart and used them to push me forward in the early days of entrepreneurship. Years ago, upon handing in my 2 weeks' notice, my boss doubted my ability, telling me that I'd never make any money and that I, quote, "I guess you've given up on the good life." Remembering this slight and keeping it top of mind served as bulletin board material for me during the lonely, uncertain days of small business ownership. I may have been scared, but there was no way that I was going to let his negative prophecy become my reality. Emotions play a complex role in our lives, particularly when they intersect with the fraught world of personal finance. At their extreme, emotions can distort and impair our ability to make wise financial decisions. I stand by what I said in The Laws of Wealth. If you're excited about an investment, it's probably a bad idea. But if properly and thoughtfully aligned with our personal financial plan, emotion can also serve as rocket fuel that helps us do the hard work of saving, investing, and giving. Like so many things in life, emotions can be poison or cure, depending on how we harness and position. Thank you for listening to this, the secret track from The Soul of Wealth, one of the essays that actually did not make the cut. But hope you still enjoyed it and learned a little bit. Thank you again to all who have purchased The Soul of Wealth. If you haven't yet, it's only 2 days old. Go out and get your copy now. And thank you again for all of your support.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.